If I had to pick one ICT concept that's completely changed the way that I trade pretty much every asset there is, it's hands down, without a doubt, the ICT breaker block. This single PD array or concept has allowed me to take a higher win rate, get on side with the higher time frame algorithms more effectively and more efficiently or regularly, and it's allowed me to take less losing trades because I'm able to use it to qualify valid liquidity sweeps. Now, unfortunately, because it's so powerful, lots of people teach it a little bit differently than me, and in my opinion, it's not quite right because lots of them are just using order blocks. So today, I'm going to break down the difference between an order block, a breaker block. I'm going to show you what a breaker block is, at least in my terms or definition, and I'm going to show you some trades that could have happened over the past couple of days using this very simple yet very effective trading strategy. So if that sounds like it interests you, make sure to stick around and let's get into the charts. Okay, so first thing, to understand the breaker block, I'm just going to use this quick little line diagram. I'm sure you've seen it a bunch of times, but I just really want to drive forward a few points here that I think get missed a little bit too often. So the first thing we have to identify when we're looking at a bullish breaker block is we have to know that we are in a downtrend. So we have to see lower lows, lower highs, lower lows, lower highs, lower lows, not a lower low. Right? This right here is a proper market structure shift, and this is actually a market structure point. In my opinion, the best breaker blocks have a proper market structure shift or a proper market structure point associated with them. It's not just any swing high or swing low, unless you're trend following. And maybe I'll do a whole nother video on the 3 different types of breakers in my opinion, but essentially here, I'm just going to explain the basic reversal breaker and the one that I actually use primarily. So you need to have this shift above this high. That's the first step. The reason why they're so strong and so viable or valuable is because every single breaker is automatically going to have some form of a liquidity sweep in them already. So you take out this low, trap the short sellers, and then start to push price up. That's great. Then you see the shift in structure, and your initial thought should be, I'm going to look to get long somewhere in this range right here. From this low to this high. Now, it's not just anywhere in there, and so give me 1 minute and I'll make sure I clear all that up for you, but essentially you're going to look for price, something specific in here, a specific type of candle in this range here that shows you what the breaker block exactly is. It's very mechanical and it's very strict when it comes to the rule sets here. So we're going to look for some form of buy-side liquidity up here to target. This could be a fair value gap if you're looking to take profits a little bit earlier, or an equilibrium point like that if you're fading the trend. But for the most part here, we want to be following a higher time frame trend. So with higher time frame buy side liquidity pools up here, and then we're going to be looking for lower time frame fair value gaps or liquidity pools in here to kick us back up in line with the higher time frame order flow. So we, like I said, we're going to look for price to come back into this area, and we're going to look to enter off of this for price to continue higher. This is not a break and retest. Sometimes it looks like this. Sometimes it happens to be this. But it's not all the time. And there's a very specific rule in here, and that's that you need to find the candle for a bullish breaker block that has the highest up close, the highest body. It needs to be green, so the closing price needs to be the highest. It's not about the wick. The wick is incredibly important when it comes to finding this swing high here, because it needs to be a market structure point, and in order for it to be a market structure point like this, it needs to have a swing low on the left and a swing low on the right. So once you've identified this, we're going to look for the candle in here that has the highest up close body. If that happens to be here and not at this swing high, you look for price to come down through this old swing high into the breaker block and then to continue up. Okay, this is how I trade. So I know that's a little bit confusing right now, or I'm sure it is. It's not quite clear when you don't see the candlesticks. So let's go ahead and just hop right into the candlesticks, and it's going to clear it all up, and then we'll go over the bearish case. Okay, so here's our first example. This is going to be on the NASDAQ. Right now we're on the 15-minute time frame, and this dotted line right here is going to be our 9:30 equities open, and that's usually when we like to trade. That's going to be the New York session. So first thing that I'm going to do here on the 15-minute time frame is just mark out my session liquidity. I can see we took out the Asia high, we took out the London high, then the Asia high, of course, and now we're looking at this potential London low down here, and I see some nice sell side here and some nice sell side here. So I think price probably wants to run towards the London low and give us a bit of a seek and destroy profile, or a seek and destroy market condition here. So what I'm expecting is probably for price to run some of these lows, would be great if it ran all of them and then we didn't have to worry about any of them and then maybe come back up and take out some highs. That would make sense given the price action that we're seeing right here. So let's just go ahead and play this out. Just play the next 15-minute candle. Okay, so we took out some sell side here. I'm going to go down to the lower time frames because I do know what ends up happening here. Like I said, I picked this example for a reason, and that's that we actually end up leaving this low intact here and creating some SMT here. So I'm just going to go ahead and mark this out with SMT, you can see. And that's going to be SMT with ES, so we don't need to take this low out anymore. This liquidity no longer needs to be swept because we made SMT there. We're now going to go back down into the 1 minute time frame here. And we're just going to wait and see when we create this swing low. So now we've made a swing low here. Nice little initial information. And at that candle right here, I'm just going to bring these lines over here. I'm going to remove this one just to keep it real simple and straightforward to see. This is going to be our liquidity we took out. Made some SMT down here. And if we're looking for potential buy side targets now, we can see we have these highs right here, right? These highs are low resistance liquidity run, or they're relatively equal. So we're going to look for price to probably come up here and for this to act as original consolidation, if you know what I mean. So we've got a bit of a breaker block forming here. You can see we shifted structure, got above this high. And that means that this candle right here is going to become our breaker block. Okay, so you can see we have high. We could start way up here, but we have high, low, high, low, higher high, right? We got above this high, we closed above it, and we displaced, right? This is clear displacement with a fair value gap. This is what we want to see for price to likely run towards this high. So the aggressive entry here is to go and place your entry right here, put your stop loss anywhere in here if you'd like. You should be pretty safe below the breaker block here, and that would mean you have to trust that this fair value gap here is going to be a breakaway gap. So the better thing to do would be at least cover consequent encroachment of that gap. And then you can look for price to come all the way up here. And obviously your low-hanging fruit objective is going to be this high paired with this high here. So some nice relative equal highs here. And then of course your terminus or your target up here. So this is the aggressive entry. The conservative or the more safe entry would be to wait for price to create a fair value gap overlapping it. But let's just go ahead and see what plays out. So now you have another fair value gap overlapping it. This breaker just got really high probability. The last thing that I want to note is let's take a look at the time. Okay, so we're now 9:50. I'm just going to go ahead and make this a dashed line so you can see that a little bit better. See the candlestick that is? So this is 9:50. Our order hasn't been placed, which means we are in the macro. Our order is placed here, I should say, but we haven't been tagged in. So we're inside the macro. Price comes down and picks us up. You could have taken the fair value gap there as well. That's totally viable or fair. But we're going to stick with the breaker for the sake of the video and for the sake of adding confidence and getting the best entries. And so now we kind of wait and see what price does. Wait for it to play out. So you can see price is now taken out buy side liquidity inside this macro. It's exactly what you want to see price do, right? Price during macros is going to rebalance inefficiencies or run liquidity. We've already ran some liquidity here. So if you wanted to move to break even, you could, but we'll just leave full risk on here. Let's just go ahead and keep playing this out. So now we're out of the macro here, but price still comes up and takes out this high at 1020. So now you could have met that target. You would have had a 3.33 risk to reward there. If you wanted to cover both of these fair value gaps, you still would have had a very positive risk to reward at 2.44. For me, my minimum is 2. I don't like to go below that. So as long as I can get 2 to 1 risk to reward out of a trade, it's viable and it's something that I'm willing to take. So a really nice opportunity there. As you can see, breaker block's pretty obvious, right? It's not this high here. Could that have got you filled? Yes, but it's not technically correct. And we want to be very specific when we talk about these concepts. It's the up close candle here. And if you take a look, this is a swing high here with a swing low on either side. That's going to be your market structure point, and that's going to be what you're looking for a breaker in. It's the highest up close candle. It's the only one, so it's really easy in that case. Then you have the macro and time of day lining up, and you have really nice relative equal highs up here with a nice liquidity sweep below us and some really obvious SMT. So price does push up, takes out the buy side, and now let's go ahead and find our second example. So next example I want to go over is actually a live trade that I took, and I do have a recording to prove the whole thing and just show you guys that it's not just all hindsight knowledge that I'm talking about. This is actually how I trade, and I did have some commentary over the video, but it was really early in the morning for me. I was up around 6:30 for the NFP news, so I just want to make sure that I think I'm going to talk over it instead and not give you the live commentary because it's not very good. I'm not very happy with how the end result came out, but essentially what you're seeing in the back here is you're looking at gold on the left and you're looking at the NASDAQ on the right, both actually setting up for a breaker. So I was looking for shorts on the NASDAQ and longs for gold, and we're actually going to go over both of those things right here. But essentially here, we're just going to start with gold. You can see we've got the fair value gap here, which is initially where my entry was inside the breaker block. But what I've done here is I've actually adjusted my entry to suit the breaker block instead of the fair value gap. So now I've got my entry where that breaker block is, and we're just expecting these lower fair value gaps probably to stay open because of that. So as price kind of comes into that breaker block there, I get tagged in. And now we can just kind of set and forget this. We're looking for higher prices here. We've got our trade and our limit orders set, our stop loss and our take profit set. And so now we can just kind of sit back and watch this play out off the breaker block as it runs up towards our take profit and towards that buy side liquidity pool. Okay, so I do have this trade going at 100x right now in the background, but essentially we're looking at the 5-minute time frame here. You can see the breaker clearly marked out there. It's the highest up close candle before the liquidity sweep or the breakdown there that traps the shorts. Price then expands up a little bit higher, creates that displacement with those fair value gaps, shifts market structure, and then price eventually comes back down into that, tags us into the trade, and is now starting to pull away towards the highs. It's also worth noting that on silver, we had really awesome and super obvious 1-hour highs, 4-hour highs, whatever you want to look at it as. And so we're really paying attention to those highs, looking to take those out. And this is what kind of sparked the idea to go long the gold contract here. We also have some SMT at the very low here. I don't currently have it marked out, but the low of the day here at about 9 o'clock actually has some SMT with the previous, I think it's previous day low, but at least it's very obvious on the 4-hour. So now we've actually got to the point where gold hasn't quite taken out our take profit and hasn't quite taken out that buy side liquidity that we have marked out above us. But we do have silver taking out those equal highs that I was mentioning. So what I've actually done here is I'm just typing out, but we're going to move our stop loss up to break even so we don't have some SMT form at the high and eventually end up having price come all the way back down and stop us out. We're not going to take profit. We're still going to stick with our 2R. We still expect price to run through that buy side liquidity and probably up to the higher one as well. But just to save ourselves and to cover our trade and mitigate our risk, we're going to move our stop loss to break even in case we do have some SMT up there that comes down and brings price all the way back down to our entry. We no longer want to be in that trade. So as you can see here, stop loss goes up. And then eventually that doesn't really matter because shortly after, price goes up and takes us out for a nice winning trade or a pretty quick and easy 2-to-1 risk to reward. Okay, so now that we've gone over that bullish breaker block a little bit more in depth, let's take a quick look at what these bearish breaker blocks are going to look like because sometimes it's hard to actually flip those things in your head if you don't know what you're looking for. So the first thing we're going to need, just like in the bullish case, is we're going to need a trend. In this case, it's going to be a trend higher, and then price is going to need to break that trend. And we're not talking about a trend line here. This low here, this market structure low that has a high on either side, specifically with a higher high on the right, is going to be your market structure point, which means that when price breaks through this, you're going to have a market structure shift and a proper one. Once this occurs, you're going to look in this range here, from the side of this low, and likely that's where you're going to find the breaker block. Sometimes it's going to be here, sometimes it's going to be here, right? Which is why we don't just take this entry right here. There's points where this will be the case, but for the most part, we want to look for this very specific candle here that's going to have the body that is the lowest or the lowest down close candle in this range. That's going to be your breaker block. If there's a series of candles, we're going to use the series. So once you can find this retracement back into this area or this breaker block, you can then look to target the sell side liquidity down here. And you should have a pretty low resistance liquidity run if you have applied the concepts correctly. And if you can see that we've been building up just higher highs and higher lows like this, that means that stop losses tend to get ran pretty aggressively through this run down here. And the best scenarios are when you find engineered liquidity like this as well. This tells me that we're going to have price wanting to not only run towards this, but to and through that, and likely towards this low here. So hope that kind of makes some sense. But just like in the bullish case, if it's a little bit confusing, once we get into the actual candlestick chart, it's all going to make some sense. So let's go ahead and do that. So the first thing I notice here on the NASDAQ is that we're currently trending up, which is totally fine. That doesn't mean we have to look for shorts yet. But the first thing that stands out to me when I do look at this chart here are these relative equal lows down here. You can see we've kind of got this consolidation going on here. And so this is going to end up being a nice low resistance liquidity pool. And we're ultimately going to expect price to come and revisit that at some point in the future. Now, if you've been with me or you've seen some of my older videos when I used to do our weekly market updates for free on TikTok, you know that I would say pretty frequently, don't fade order flow and don't fade market structure. We're clearly in a bullish trend here. So until order flow or market structure shifts or changes, we don't want to look for shorts. This is what keeps me out of losing trades, okay? We're not just going to look at any swing low in here and trust that it gets broken through and that's going to be our market structure shift. We need to see a breaker and we need to see some displacement. So let's just go ahead and play this price out. Remember that in order to see a breaker or a bearish breaker, we want to see something like this, right? This pattern or this schematic needs to play out here. So if we just keep playing this out, let's go ahead. Okay, so we made another high here. There's a little swing low here to form, but that's not a market structure low. Okay, so we took out this high, but there's no swing low in here, and now we're getting some displacement. Now, we're getting some displacement, and the shift in structure is not this swing low. Okay, if we zoom in here, this swing low, irrelevant to me. Doesn't even matter. The important part here is this low here. Right, this is the low that has a swing high on either side with a swing high on the right that is higher. This is going to be your market structure point. This is going to be where you look for your breaker. Now, when you look for your breaker, just like I said before, you're going to look for this range in here. Remember, this range here is where you're going to look for your breaker. Coincidentally, in this case, it's actually that entire range. So it's going to be the candle with the lowest body. That tends to be this candle right here, or the lowest closing price, I should say. Lowest body if you're thinking about it in terms of down close candles, but if you're thinking about it in all candles, it's the candle with the lowest close. That's your breaker block. So it ends up being this entire black candle here, or this down close candle, and now we've shifted order flow because we are no longer bullish. This fair value gap didn't hold us. That order block didn't hold us. That bullish order block right here, if we were bullish, this would have been a bullish order block. That's now failed, and smart money gets to mitigate their losing trade in this breaker block and send us lower. That's the whole idea here. So we can look for entries right off this breaker block right away. We can use that wick, right? This is going to be the aggressive entry. Put your stop loss at the high if you want, or you can look at lower prices here. And before I get too ahead of myself, it's also worth noting that this is on the 4-hour time frame right now, but that doesn't mean that it only works on the 4-hour time frame or anything like that. I'm going to go over a different lower time frame setup next, and I just want to show you that it does work across all time frames here. So if you do take a look, we've got the 4-hour breaker here. I'll just go ahead and mark this out the same way that I did the bullish one here. So you can see that's obviously a breaker block, or it's marked out as a breaker, and it's going to be this gray box here. And I'll just make this smaller so you can actually differentiate between the two. And what would make this higher probability is if we get a fair value gap over it. And now we do. So you can see that we now have this fair value gap that's printed right here between this candle's low and this candle's high. High probability. If you want to take a trade right off the fair value gap, you're more than welcome to. But remember, I need at least a 2-to-1 risk to reward. So we're going to go up to the breaker, as we have done in the past. And you can see price has a tendency to come back up into this breaker block. And I want to be very clear, this is not the order block. Okay, this is the breaker block. This is the bearish breaker block. The bearish order block is actually way up here. So we're going to keep in mind that this is our breaker, and now price is starting to descend lower. And a good indication right now, as order flow continuing lower, is for this fair value gap in here, right on this candle, to fail. Now, it doesn't need to fail, right? We're still in the trade. We're still trusting the market structure and the order flow that's clearly bearish, but that's a really good early indication that you're going to have a low resistance liquidity run. We come up one more time, make a new high here, but still not a lot of displacement to the upside. We're still holding pretty bearish here. And now price is starting to get into this fair value gap here. Let's see if we can flush through it. There you go, obvious displacement through, and now we're probably going to get our low resistance liquidity run down to these lows. And just like that, you could be out of your trade. Now, obviously, this would be a swing trade or a position trade since it's on the 4-hour time frame, but the concepts and the theories work across all time frames. So now, hopefully this is starting to make some sense to the bearish side here as well. You can see how this looks very similar to this, right? We're not just trading the pattern. You have to use theories and concepts like liquidity down here, time of day, day of week, high time frame PD arrays, high time frame liquidity sweeps, and things like that to build out your narrative. But for the most part here, this is a very clear-cut trade, and it should become fairly clear to you to see that this entire candle here is your breaker block. Does this wick concern me? No. This wick does not concern me. I don't care that we wicked above it. All right? The bodies tell the story. The wicks do the damage, the bodies tell the story. As long as we're still holding that with our bodies or with the candle bodies, we're still fine. Okay? So now let's go ahead and move on to the next example, which will be on a lower time frame. So you guys remember that NASDAQ breaker that I was talking about when we were going over the gold trade? Well, that's actually what we're going to go over now. And it's because it's a really nice bearish breaker. You can see it on multiple time frames. And it's also a trade that I took in the same time, or at the same time, I should say, as I took that gold trade. So the previous example that I had, I'm just going to remove it from the video and we're going to go over this one. Unfortunately, I don't have a live recording of this because my recording software was recording gold, but we're just going to go through this and then I'll show you the picture of my executions just to prove that I'm not lying. So to start here, obviously, let's go to the 4-hour time frame because this is what I based this off of. We had this 4-hour fair value gap here, the bearish one, expecting prices to probably run lower from inside of it. We also had this bearish breaker block here. Okay, so if we take a look, the breaker will be this candle and this candle, right? High, low. Don't care about this high because there's no swing low here. So this is your higher high. Between this high and this high, this is the only swing low. So this becomes your breaker, not this candle here, but this candle. And since there's two down close candles, they're collectively the breaker block together. So with that knowledge out the way, I'm just going to delete the line there so it doesn't get confusing on the lower time frames, but just know that's what we're currently looking at. Now, when we go down here onto the 1-minute time frame, which is what I was looking at, I will just drop a quick photo of my prediction for the day or what I was looking for during the market open or the New York Stock Exchange open. And essentially, it's one of my 2 NFP protocols, which is a 2-stage delivery. My students and what will be in my course, I guess, in the future here is going to be the other one, which is a RTH move. But essentially, this 2-stage delivery here is what I look for and actually prefer on NFP days, which means the price is going to come all the way back down here and take out this consolidation low down here. Starting to look pretty familiar, I hope. So we can see that price has taken out some buy-side liquidity here. Remember, our context here is this 4-hour fair value gap. So right now, we're wicking above it. But remember, the bodies tell the story here. So as long as we don't close there, we should be okay. In doing so, we end up taking out this short-term high here. And what else we do here is we also create SMT with ES. Okay? This is a really good signature in price and tells us that our breaker block is probably high probability. As we start to come through this low here, we have to see this low is going to be the low that we need to break in order to find our breaker, right? This is our market structure low, the low between the 2 highs with the higher one being on the right. Now, if price gets through this, where's our breaker block? Because it's not this low, at least not on this time frame. It is on a different one. But it's actually going to end up being this candle right here. Okay? So this 1-minute breaker right here, or this 1-minute candle here is the breaker. And as you can see, the reason behind that is because in between this high and this high, it's the candle with the lowest closing price. This candle, the closing price is up here. This candle, the closing price is down here. No other candle between here and here has a lower closing price or a lower body than this candle right here. Therefore, this candle here becomes your 1-minute breaker block. Okay? Now, I'm preparing to short here, but I'm not quite yet. I'm kind of focused on the gold trade at this time, but I'm very well aware of what's going on here and realistically hoping the price gets through this low and gives me an opportunity to short all the way down to these lows. If it needs to go there, I'm going to end up taking profit before that, and we'll go over why. But essentially, this is what I'm looking for here. I'm going to delete the box just to keep everything clear. So price ends up rejecting off of this order block right here. These 2 green candles are the order block, and now we've shifted structure. So this breaker block is now valid. But what I'm going to do is just end up playing out a couple more candles here till 9:25. What that does is that gives us a 5-minute, I'm going to delete this breaker line here, gives us a 5-minute shift in structure. We can see high, low, higher high. This low here has now become a 5-minute breaker block. Okay, so on the 1-minute time frame it wasn't, on the 5-minute time frame it is, and it's because it's now a down close candle. And not only is it a down close candle, it's a down close candle with the lowest closing price. If you take a look at this one, this candle's lower. If you take a look at this candle here, they're actually equal. So we're going to elect to choose the one with the lower wick. Okay. If this wick was higher, we'll use this candle here. But this, in this case, since we have more than one consecutive down close candles here, the breaker block is actually these three. Okay, these three candles collectively make up the breaker block. But my preference is always in the first one. That's usually where I'm looking for my entries. That's usually where I'm looking for overlapping fair value gaps or other PD arrays. And that's my preference when it comes to entries. So I'm going to go back down to the 1 minute because the 5 minute gave us a little bit too much information there. It gave us a hint as to what's happening. And I placed my order right here at the 5 minute breaker with my stop loss above the high. Okay. Initially, my targets or my thought process is price is going to come all the way down here to these sell side liquidity pools, just like in the schematic I showed. But what I end up doing is finding equilibrium, and there's a reason for this with the RTH gap as well. But I look at equilibrium here, and I think if I'm wrong, where am I likely to be wrong? If price is in fact not running to this low, where am I likely to be incorrect? And I think at this point, we've made the breaker. If I'm wrong, price will probably come at or right around this equilibrium point and then potentially continue, which is not my preference. My preference is for price to go lower, like you saw earlier. But this point here is where I can be wrong and still be well in profit. So I end up taking profit just below this low. And we'll get into that in a second. So price ends up coming up and it tags me in right here. Now we have 9:30 opening price here, or 9:30 equities open. Price gets a really nice initial push down, but does end up coming back up. We're not worried about this, okay? We didn't move our stop loss up here. We didn't start freaking out because it was coming back against us here. We left full risk on because we trusted the model, we trusted the plan, and we knew where price was likely to go. And in doing so, price hits that breaker block a few more times and then eventually starts to get our rejection down. And when does this speed start to come? Well, right in the macro. 950 is right here. Let's go ahead and drop this behind the other candles so you can see a little bit clearer. This fair value gap here is right at 950. That's where a potential short opportunity was again. And then price continues to head lower. And this is at this point here, now that we're below equilibrium, I'm actually trailing my stop loss right around this equilibrium point. And I actually get out of the trade, or I get stopped out for a profit, of course, about right here, about halfway into this small little wick here. It's a little unfortunate because what does end up happening is price sells off pretty aggressively right after that and runs towards the terminus or the main target that I was looking at. But either way, a really good setup. The last thing that I would talk about here is when does this sell side liquidity get taken? Inside the macro, right? So in between these two white lines here is your 950 to 1010 macro. And this is where price is going to, like I said earlier, rebalance inefficiencies like this one in here, or run liquidity. And that's ultimately what it does, is it runs our sell side liquidity and delivers our target for the day. So I hope this is starting to make some sense and you can see what I'm talking about when it comes to breakers, the importance, and how actually useful and impactful they can be. If you do have any questions, make sure to let me know in the comment section down below. If you enjoyed the video, if you found some value in it, or if you want to see more of my content, obviously drop a like on the video. I would always appreciate that. Subscribe if you're new and want to learn more. And if you are interested in trading with me, joining the mentorship, learning more about this stuff, obviously you can check my links, and there's actually a free newsletter that I'm going to be sending out every single Friday that goes over trades just like this. It's going to be called The Breakdown, and it's my Trade of the Week newsletter. So if that sounds like an interest to you, it is free and you're more than welcome to sign up for that. That's all going to be in the links in my bio or in the description. So if you are interested, make sure to check those out. And like I said, if you do have any questions, put them in the comment section down below, and I will do my absolute best to answer those and make sure everything is sorted out for you. And until next time.